Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a business valuation expert focused on strategic planning and exit planning in St. Louis, Missouri. Today, we are talking ERC tax credit information for advisors and business owners with Catherine Tindall. She's a CPA in California, specializing in tax credits, and is also a partner with Dominion Enterprise Services. She's combined proprietary technology with professional expertise with her CPA team and is able to offer a fast turnaround time on credit claims while maintaining a high degree of precision. It's her mission to help business owners in key industries affected by COVID shutdowns, such as restaurants, construction, and hospitality, to take advantage of the employee retention credit before it begins to expire in the spring of 2024. Welcome, Catherine. How are you?
I'm doing well. How are you? Thanks for having me.
But maybe
Yeah.
you can just tell us like some of the pitfalls of the calculation of the ERC tax credit and, even maybe where people are just, maybe it's more in depth in certain areas, but people are looking in the wrong areas. But like,
Mm.
what are people really stumbling on, practitioners in this space, maybe?
Yeah, so I'd say the first one that I see practitioners stumble on is a lot of them are unaware. They're aware of the revenue rules. They might be unaware of the alternative quarter election, which allows us to use one quarter's, revenue eligibility to trigger the next quarter being eligible. So the common one I see people miss on that is not realizing that if you have in Q4 of 2020 showing a 20% decline in gross receipts compared to that same quarter, Q4 2019, that actually triggers Q1 of 21 to be eligible for the program. So that's a common one I see people miss. Another one I see people miss is thinking that if they got PPP, they're not eligible for ERC. That's not true. It was originally, that's how the program was written, but that was subsequently changed, and a lot of practitioners miss that. I think almost every case that I do has both PPP and ERC. They do interact with each other. The PPP can wipe out, a portion of the ERC, but it's still, like I said, almost every case I do has both. So that's a common pitfall that people miss. Another really common pitfall that I see people miss is not understanding what's going to be a qualifying government order. And so the pieces that we look for there is that the government order itself is, coming from a state level, coming from some kind of governmental entity, that it's enforceable on the client, and that it's forcing a more than nominal change in the business. So we're looking at a more than 10% effect on their business, and that the portion of the business that is being affected, it's being affected in a more than 10% way. Those are the two bright lines, but a lot of practitioners don't. They're intimidated by those rules because there's some complexity there and some legal interpretation. Like we have a staff attorney that's what he does is, make sure that the government orders are sufficient for what the IRS rules are. A lot of practitioners don't feel comfortable making that judgment call, and so they'll only look at the revenue quarters and not look at the government orders. So that's another common pitfall we see for the program. And then just other calculation pitfalls, things like people not understanding how to do the PPP allocations with regular ERC wages, not understanding some nuances around disqualified wages. So if you have owners in the business and family members in the business, do they need to be disqualified? It depends is the answer. Things like that. There's a lot of little tricky bits that can sway the credit a lot. And a lot of practitioners, unless you've, read through all the IRS FAQs and the legislation we have, you might miss something that's important. I guess one other piece that's a common pitfall that, I should make mention of is that this program has what's called aggregation rules. And so if you have multiple businesses that have a shared ownership structure, we actually have to aggregate them into one claim. And so very often practitioners will miss that what they're dealing with is an aggregated claim. And that can be beneficial or non-beneficial. It just depends on the situation. But I've had companies not think that they were eligible and then didn't realize that they had a sister company that was eligible for the program that then triggers them for eligibility. So that's a common thing that people can miss as well if they're not familiar with the aggregation rules. So those are the most common pitfalls that we see.
And what if we get, I have a lot of clients that thought about taking the PPP and didn't because they kind of knew that they were still profitable. I do have one client that actually gave the PPP money back because they had certain fiduciary responsibilities and they didn't want to claim that they had taken PPP when they took it, but they didn't need it. So they gave it back, and it was a lot of money to give back. So I'm just wondering, is there to me, it seems natural to say, okay, I got PPP. Let's look at these other credits.
Yeah.
But isn't there an opportunity, like if you didn't maybe qualify for the PPP or you lost out, but you did keep your employees and you did pay that money and you did all of that? Isn't that really where you should be considering a potential credit as well, like regardless of the PPP situation?
Yeah. Because, the main issue I usually tell people, if you qualified for both rounds of PPP, it's likely you'll qualify for ERC because the programs are somewhat similar. And if you didn't get PPP for whatever reason, the program's closed, you can't go back at this point and get it. But, most people where they got PPP, we can't double dip on the wages that are used. And so if you didn't get PPP, that now you don't have that being pulled out of your ERC, so you can qualify for potentially more. But so that's, that is a nice feature for people who didn't get the PPP money, is that, it will potentially bump up your ERC. Just, it depends on the timing, et cetera. But, it is still a program. And I think for a lot of people who, had concerns about, well, we're doing well, we don't need a handout, we don't want to do PPP. I'd say a distinction to consider for this program is it's really a tax credit. So it's not like a handout from the handout from the government in the same way. It's just baked into the tax law. So like how you're able to deduct expenses and, be eligible for, preferential treatment with rates or whatever it is, this credit program is the same way. So you do have like a legal entitlement to the money. It's not really, you don't have to take advantage of the program, but, it's not the same thing as PPP where it was at the government's discretion to hand it out. It was at the government's discretion to forgive it. You really do have a legal entitlement to this money. Just like, you have a legal obligation to pay your taxes, it's on that kind of same level. So I think for a lot of people who didn't do PPP for, reasons beyond, qualification, they didn't feel comfortable with, doing a government aid program. This program's a little different because it is a credit. It's designed for you to take advantage of it.